Welcome back. In this Money Smart Basics video, we are going to blow your mind. The secret's in this classic book. It simplifies smart investing, so you don't need to be a Wall Street wizard. Unlock the knowledge today and watch your investments grow. Please remember to like, subscribe, and comment for more Money Smart Basics videos. Stay until the end to receive a bonus tip. Hello everyone, today we're diving into the investment classic, A Random Walk Down Wall Street by Burton G. Malkiel. This book, first published in 1973, challenges conventional wisdom and provides a clear, straightforward approach to building wealth. Join me as we explore its core tenets, breaking down complex concepts into easily digestible segments. Before we delve into the book's core concepts, let's get to know the author, Burton G. Malkiel. Malkiel is a distinguished economist and professor at Princeton University. His book challenges the notion that anyone can consistently predict market movements, introducing the efficient market hypothesis. Through his work, Malkiel empowers individuals to become informed investors. Is a book written decades ago still relevant today? Absolutely. The rise of high-frequency trading and complex financial instruments reinforces Malkiel's key takeaways. His emphasis on long-term investing, diversification, and ignoring short-term noise is even more critical in today's volatile market. Malkiel's message of patience and discipline provides a refreshing alternative to get-rich-quick schemes. At the heart of A Random Walk Down Wall Street lies the efficient market hypothesis, EMH. The EMH posits that stock prices reflect all available information, making it difficult to consistently outsmart the market. Imagine a giant mosaic made up of millions of tiny tiles, each representing a piece of market information. The EMH suggests this mosaic is always complete, with each tile in its correct place. While short-term gains are possible, consistently outperforming the market over the long term is highly improbable. This concept forms the foundation of Malkiel's investment philosophy. Let's bring the EMH down to earth with some real-world examples. Positive or negative news about a company is quickly factored into its stock price by the time you hear about it. The EMH illustrates how efficiently information is incorporated into stock prices, driven by countless investors acting on their own information. What does the EMH mean for you as an investor? It highlights the importance of long-term investing and diversification. Short-term market fluctuations are often driven by noise and speculation. By focusing on the long term, investors can benefit from the overall upward trajectory of the market. Diversification helps mitigate risk and reduce the impact of any single stock on your portfolio. Malkiel argues that short-term stock market movements are largely unpredictable, resembling a random walk. Just like you can't predict each step of a random walk, you can't predict short-term market movements with consistent accuracy. Instead of trying to outsmart the market, focus on building a diversified portfolio and holding it for the long term. This approach aligns with Malkiel's philosophy of patience and discipline. One of the most enduring messages of A Random Walk Down Wall Street is the power of long-term investing. Malkiel emphasizes that while the market may seem unpredictable in the short term, it reflects economic growth over the long term. By investing consistently and staying invested, you can benefit from the power of compounding. Time is your greatest ally in the market. Many investors fall into the trap of trying to time the market, but this is much harder than it sounds. Instead of trying to time the market, Malkiel advocates for time in the market. Staying invested for the long haul allows you to ride out market fluctuations and benefit from the overall upward trend. Focus on your investment strategy, risk tolerance, and time horizon to achieve your financial goals. Malkiel is a strong advocate for passive investing through low-cost index funds. Index funds offer instant diversification and tend to have very low fees compared to actively managed funds. By investing in an index fund, you're buying a small piece of many companies, mitigating risk. For most investors, low-cost index funds offer a simple, effective way to participate in the stock market. Embrace a passive investment approach to avoid the emotional pitfalls of stock picking. Diversification means spreading your money across different asset classes, industries, and geographies. This reduces the impact of any single investment's performance on your overall portfolio. Malkiel emphasizes that diversification is one of the most effective ways to manage risk. It helps protect your capital from significant losses and ensures your financial future isn't riding on a single investment. Now that we understand why diversification is crucial, let's discuss some practical ways to build a well-diversified portfolio. First, diversify across asset classes. Don't limit yourself to just stocks or bonds. Consider a mix of asset classes such as stocks, bonds, real estate, commodities, and even alternative investments like private equity or hedge funds. Each asset class has its own risk and return characteristics, and by combining them strategically, you can create a more balanced portfolio. Second, diversify within asset classes. Diversification doesn't stop at the asset class level. Within each asset class, you can further diversify by investing in different sectors, industries, and company sizes. For example, within stocks, you can invest in technology, healthcare, consumer goods, and other sectors. Third, diversify geographically. Don't limit yourself to your home country. Consider investing in international stocks and bonds to gain exposure to different economies and regions. Global diversification can help reduce the impact of economic or political events in any single country on your portfolio. And finally, consider your time horizon. Your investment time horizon, how long you plan to invest your money, should influence your diversification strategy. If you have a long time horizon, you can afford to take on more risk, which might mean allocating a larger portion of your portfolio to stocks. Conversely, if you have a shorter time horizon, you might choose a more conservative approach with a higher allocation to bonds or other lower-risk investments. Weathering the storms, how diversification protects your portfolio. To truly appreciate the power of diversification, it's helpful to think about how it protects your portfolio during market downturns. Imagine two investors, Sarah and John. Sarah has a diversified portfolio consisting of stocks, bonds, and real estate. John, on the other hand, has all his money invested in a single technology stock that's been performing exceptionally well. Suddenly, there's a market downturn triggered by an unexpected economic recession. Technology stocks, being more sensitive to economic cycles, take a nosedive. John, with all his eggs in one basket, sees the value of his portfolio plummet. Sarah, however, fares much better. While her stock holdings decline in value, her bond holdings, considered a safe haven asset class, remain relatively stable. Her real estate investments also hold their value, providing further cushioning against the market downturn. This example illustrates how diversification acts as a shock absorber for your portfolio. By spreading your risk across different assets, you're less susceptible to the ups and downs of any single investment or market sector. When one part of your portfolio is struggling, other parts may be performing well, helping to offset losses and smooth out your overall returns over time. Section 4. Beyond stocks and bonds, exploring different asset classes. While stocks and bonds often form the core of a diversified portfolio, it's essential to remember that there are numerous other asset classes that can provide further diversification and potential growth opportunities. Real estate investing in real estate can offer a hedge against inflation and provide rental income. You can invest in physical properties, real estate investment trusts, REITs, or even crowdfunding platforms that allow you to invest in real estate projects with smaller amounts of capital. Commodities. Commodities are raw materials like oil, gold, and agricultural products. Investing in commodities can provide diversification from traditional asset classes and act as a hedge against inflation. You can invest in commodities through futures contracts, exchange-traded funds, ETFs, or by investing in companies involved in the production or processing of commodities. Alternative investments. Alternative investments encompass a broad range of assets beyond traditional stocks, bonds, and real estate. Examples include private equity, hedge funds, venture capital, and even collectibles like art or wine. Alternative investments can be more complex and illiquid than traditional assets, but they can also offer higher potential returns and further diversification benefits. When considering adding alternative investments to your portfolio, it's crucial to do thorough research, understand the risks involved, and potentially seek advice from a financial advisor to determine if these investments align with your overall financial goals and risk tolerance. Section 1. Malkiel's Enduring Principles in a World of Market Volatility. We've covered a lot of ground, from the efficient market hypothesis to the power of diversification. But how do Malkiel's principles hold up in today's financial landscape? The answer, as you might expect, is incredibly well. If anything, the increasingly interconnected and volatile nature of global markets has only reinforced the importance of Malkiel's core messages. Think about the major financial events of recent years: the 2008 financial crisis, the rise of cryptocurrencies, the COVID-19 pandemic, and the subsequent market volatility. These events have tested even the most seasoned investors, yet Malkiel's principles have remained a steady guide through the turbulence. In a world of algorithmic trading, high-frequency trading, and an overwhelming deluge of financial information, the market is arguably more efficient than ever before. This makes it even more challenging for individual investors to consistently outperform the market through stock picking or market timing. Malkiel's emphasis on passive investing, particularly through low-cost index funds, has proven to be a sound strategy for navigating these choppy waters. Let's look at some specific examples of how Malkiel's principles have played out in recent financial events. Remember the dot-com bubble of the late 1990s? Investors poured money into internet companies, many with little to no earnings, driving stock prices to unsustainable levels. The bubble eventually burst, wiping out trillions of dollars in market value. Those who followed Malkiel's advice and maintained a diversified portfolio, rather than chasing the hottest tech stocks, were better positioned to weather the storm. While they may have experienced losses in their tech holdings, their losses were likely offset by gains in other asset classes, such as bonds or real estate. Fast forward to the COVID-19 pandemic. The pandemic triggered a global economic shutdown, sending shockwaves through financial markets. Stock markets experienced their fastest bear market in history, plunging over 30% in a matter of weeks. Again, those who panicked and sold their investments at the bottom of the market locked in their losses. Those who stayed the course, remembering Malkiel's emphasis on long-term investing and the tendency for markets to recover, were rewarded. The market rebounded sharply, and many investors who remained invested not only recovered their losses, but also came out ahead. These examples highlight the timelessness of Malkiel's advice. Whether it's a tech bubble, a global pandemic, or any other unforeseen event, the principles of diversification, long-term investing, and ignoring the noise remain as relevant as ever. Section 3. Navigating the Future of Finance, the continued relevance of a random walk. The financial world is constantly evolving. New technologies and geopolitical events shape the investment landscape. Yet, the principles in a random walk down Wall Street remain a steadfast guide. Trends like passive investing and the rise of index funds highlight Malkiel's relevance. Malkiel's message of diversification and risk management is crucial for uncertain times. Embracing Malkiel's principles helps investors achieve their financial goals. The Enduring Legacy of a Random Walk Down Wall Street. Burton G. Malkiel's book is more than an investment guide. It's a manifesto for rational decision-making. Malkiel doesn't offer get-rich-quick schemes or predict the market's every move. Instead, he equips readers to make informed decisions and manage risk effectively. The beauty of Malkiel's work lies in its simplicity and clarity. He breaks down complex concepts into digestible pieces with real-world examples. Whether you're a seasoned professional or just starting, the book provides a solid foundation. In a world of conflicting advice, Malkiel's book is a beacon of clarity. It reminds us that investing doesn't have to be a high-stakes game. By embracing a disciplined, long-term approach, we can achieve financial success. Decades after its publication, the book remains relevant, guiding generations of investors. Now that you've gained insights from a random walk down Wall Street, it's time to put those insights into action. Remember, investing is a personal journey. Malkiel's principles provide a solid framework for making informed decisions. Start by defining your financial goals. Are you saving for retirement, a house, or education? Determine your investment time horizon and risk tolerance. Malkiel suggests a passive approach through low-cost index funds and ETFs. Index funds offer diversification, low fees, and long-term growth. Ignore short-term market fluctuations and get rich-quick schemes. Stay focused on your long-term goals and be patient. The financial world is constantly evolving, so stay informed. Investing can seem daunting, but embrace Malkiel's principles. Embark on your own random walk down Wall Street with patience and discipline. Don't forget to like, subscribe, and hit the notification bell for more content on personal finance and investing tips. Congratulations, you made it to the end of the video. With that, you are ahead of 90% of most people in America. Here is the bonus tip that we promise. Did you know 90% of mutual funds can't beat the market? Here's why. It's simple. High fees and poor management. Malkiel says, stick to low-cost index funds. Your wallet will thank you. Invest smart, invest safe. The information in this video is for educational and entertainment purposes only, and is not intended as financial advice. We are not financial advisors, and the content should not be construed as professional financial advice. Always seek the advice of a qualified financial advisor or other professional regarding your specific financial situation. The use of any information provided in this video is solely at your own risk. Please remember to like and subscribe for more Money Smart Basics videos.